Welcome to Home Buying Made Easy, the podcast where we pull back the curtain on mortgages, real estate, and everything the big banks hope you never figure out. Michael Dindy is a licensed mortgage loan officer with Edge Home Finance, and I'm Rachel, co-host and producer of the show. Every episode, Michael and I break down the stuff that actually matters without the jargon. This show is designed for everyday people like you and I to learn the home buying process so you can buy smarter, save more, and stop leaving money on the table. Now let's dive into today's episode.
Welcome to Home Buying Made Easy. I'm Michael, and I have Rachel with me here today. She's right over there because she refuses to be right over here, close to the camera. She doesn't think that she wants to be on the camera.
I don't need to be on my camera.
Okay. And if you're watching this, I guess if you're listening to this as a podcast, then you're not watching the camera anyway. So there's that.
So they don't even know if I'm on the camera or not.
They probably don't. But if you're watching on YouTube, you would know Rachel's not on the camera. So what do we have in store today?
Okay, today is Mythbuster Monday, and we're busting another myth that somebody believes.
A myth.
So someone said that, or asked, do I have to pay PMI? And it was like, you have to pay it. Is that true?
Well, yeah, sort of. I mean,
sort of. So it's not fully true.
It's partially true and partially not. So the reason it's true, it would be true, is because if you only put down, let's say you put down 3% on a conventional loan, or 5% or maybe 10%, you would most likely have PMI. Now, there's a couple of choices on how you want to pay that. You could pay it like all up front, and there's like an upfront kind of PMI. Then, or you could pay it by the month, and that's just put into your mortgage payment. So those are two options for doing it. You're not required to pay it if you put down more money. So if you put 20% down, there would be no PMI. PMI is called private mortgage insurance, and private mortgage insurance is basically insurance that the lender requires from you due to the fact that you're not putting as much money down. It's higher risk for them to put more money down, so they charge you a mortgage insurance, which is a gap between having that 20% down and not having that 20% down. Does that make sense?
Yeah.
So it's also interesting fact. It's called PMI if it's conventional, but it's MIP if it's FHA, mortgage insurance premium. I'm not sure why FHA thinks they're special and chose to do it that way. Or maybe conventional thinks they're special and they said, we don't want to be MIP. We're going to be PMI. Somebody said something and they came up with two different scenarios.
Well, that's kind of dumb.
FHA is different than conventional as well in this regard. Once you get to 80% of your loan to value, meaning you have 20% equity in the home on a conventional loan, you can request to have PMI removed. Once it hits, once you get to 22%, once it gets to 78%, it automatically comes off. That's on conventional. You know how long it takes to get the MIP off of FHA?
250 years.
That's a bit excessive. Yeah, you can't.
You said, do you know?
You cannot. So the only way to get PMI or MIP off of FHA is by refinancing into a different type of loan, because FHA it requires MIP.
Yeah.
Yep.
Interesting. How much is it usually to pay that you have to pay for MIP or PMI?
That depends on the loan amount. It could be like there's lenders that for PMI that are at say $40, $50 a month, all the way up to $500 a month, and FHA same way. It really just depends on the loan amount. It's based on the loan amount and risk.
Yeah. So the ways to get rid of PMI faster on conventional loans is to just like pay and pay and pay.
Yeah, pay down your mortgage balance is part of it. And then if you think about it, every year a house increases in value. So as it increases in value, there's a bigger gap happening. Mm-hmm. So if you have a 5% increase in value, plus you're paying down the mortgage, it's moving faster than you think.
Yeah.
But the typical, and if you look at your paperwork when we disclose all the paperwork and disclose all the loan and the mortgage and everything, you can see in the paperwork that it says it'll take maybe it says 11 if you're doing a 30-year loan, maybe 11 years to have PMI drop off. Mm-hmm. It really depends on the loan type, terms, meaning how long the loan is, and your loan amount.
Yeah. Okay. That's all I got.
So there you have it, folks. If you want to know more information about PMI or any other subject about mortgages and real estate, this is Home Buying Made Easy, and we are here to help any way we can. All you have to do is shoot us a note, and we'll be glad to help answer any questions you may have. See you next time.
That's a wrap on today's episode of Home Buying Made Easy. If you're ready to take your next step, our team is standing by. You can call or text us directly at 615-499-6335. You can also reach us at michael@dendyteam.com or check out the link in the show notes below. Whether you have one question or you're ready to go, we'll meet you right where you are. Thanks for joining us. From our team to you, let's make home buying easy.